We are witnessing a market phenomenon that happens only once every decade. Over the past 3 occurrences, individuals with ordinary jobs have turned modest savings into life-changing wealth. I'm talking about teachers, nurses, and truck drivers who reached millionaire status. If you overlook the pattern I'm about to reveal, you may look back with regret a decade from now. I understand your skepticism. We've all seen videos promising easy riches. Let me be clear, I'm not selling a course, and I'm not asking you to purchase anything. Everything I'm about to share is grounded in decades of market data and the real-world experiences of those who recognized this pattern and acted on it. By the end of this video, you will understand the mechanics of this shift, why it matters, and the steps you can take starting today. So stay until the end, hit the like button, and let's dive in. Picture the year 2009. The world had just endured one of the most severe financial crashes in history. People were terrified, neighbors were losing their homes, and businesses were failing daily. The media declared the economy finished, and most people reacted with panic. They liquidated their assets and hid their money for safety.
However, a small group of people saw things differently. They weren't lucky, nor did they have insider secrets. They simply understood how markets operate. When everyone sells, prices fall to levels that defy logic. In 2009, shares of companies like Apple were trading for around $12, and Amazon was at roughly $85. The S&P 500, representing America's largest corporations, bottomed out at around 670 points. Despite the panic, these companies still had products people wanted, revenue streams, and thousands of employees. Their fundamentals were intact, but their prices had collapsed due to fear. Fast forward to 2021, just 12 years later, Apple's stock had surpassed $150, and Amazon had reached nearly $3,500. The S&P 500 climbed above 4,700. Investors who put $10,000 into the S&P 500 in March 2009 saw their investment grow to over $70,000. That is a 600% return, achieved not through gambling, but through buying when others were selling. This pattern is historical. Look back at March 2000, when the dot-com bubble burst. Technology stocks crashed, and critics dismissed the internet as a passing fad. The Nasdaq fell from over 5,000 points to below 1,200, a drop of more than 75%. Major retailers like Amazon plunged from $85 to $6 a share, and Cisco dropped from $80 to $10. Yet those who bought at the 2002 bottom saw their money increase 6-fold by 2007. If they held through the 2009 crash, their gains were even higher.
Amazon shares that once traded for $6 are worth over $3,000 today, a 50,000% gain for the patient investor. We see this even further back, such as Black Monday in 1987, when the market fell 22% in a single day. Panic was rampant, and many believed capitalism was ending. Yet the market fully recovered within 2 years and doubled within 5. The same cycle repeated in the 1973-1974 crash and the aftermath of the 1929 Great Depression. The story is always the same: panic, a massive sell-off, and eventual recovery to new all-time highs. The common thread is human psychology. Markets are driven by fear and greed. In good times, greed pushes prices to unsustainable heights. In a crisis, fear drives them well below their true value. As Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." This is not just a catchphrase, it is a proven strategy that has built more wealth than any other investment approach. Consider Veronica, a teacher from Ohio.
In 2009, she invested her $15,000 savings into an S&P 500 index fund, despite being told it was too risky. By 2020, that investment had grown to over $90,000. She did not day trade or time the market. She simply bought and held.
Then there is Alex, a construction worker who in 2009 borrowed $10,000 against his home equity to invest when his peers were liquidating. By 2021, his $35,000 total investment had grown to over $250,000, allowing him to retire 7 years earlier than planned. Even during the 2020 COVID crash, when the market fell 34% in 23 days, those who remained rational prospered. A nurse named Jessica invested $30,000 in broad index funds like VOO and VTI during the depths of that panic. By early 2022, her investment had more than doubled. I know what you're thinking. It's easy to say this in hindsight. You are right. It is never easy to remain calm when your portfolio is down 40% and the news is filled with doom. This is why you must have a plan before the crash happens. You need to decide now what you will do when the next correction arrives, because it is inevitable. You need cash ready, a clear idea of what to buy, and the discipline to execute that plan when your instincts tell you to run. If you are looking to learn more about content creation, I have opened a free community where I share tips on how to grow a YouTube channel from scratch in 2026.
Join through the link below. YouTube has made many people wealthy, and I am happy to share my strategies with you. You do not need a Harvard degree or complex technical analysis to succeed. You only need to understand that when great companies are on sale due to fear, that is your opportunity. Since 1950, the market has undergone a correction of 20% or more roughly every decade. Without exception, it has recovered to reach new highs. The average return in the 10 years following a major crash exceeds 200%. The mistake most people make is waiting for the recovery to be confirmed. By the time the news is positive and your friends are talking about their gains, you have already missed the window. You don't need to pick the exact bottom. That is impossible. You just need to recognize when fear has pushed solid companies below their true value. Watch for extreme pessimism in the news, major indices dropping 30 to 50%, and that sick feeling in your own gut telling you to stay away. That fear is your signal. To manage risk, only invest money you won't need for at least 5 to 10 years. Focus on diversified index funds and avoid investing borrowed money unless you have a robust plan to repay it. As of early 2026, we are seeing increased volatility.
Interest rates remain high and consumer confidence is shaky. I am not saying we are at the bottom, but the risk-reward ratio is shifting in favor of long-term investors. Growth stocks that were previously overvalued have come back to earth. This is the environment where wealth is created. If you have money to invest, consider dollar-cost averaging. Break your total capital into chunks and invest them over 6 to 12 months. This way, if the market drops further, you buy at even better prices. Focus on quality. Buy the entire market through an index fund and let time do the work. History doesn't repeat itself exactly, but it often rhymes. These moments of crisis are rare, but they are life-changing for those who are prepared. The crowd will always get it backward, buying at the top and selling at the bottom. True wealth is built by understanding these cycles and maintaining the discipline to act when others are too afraid to move. The next time the market crashes, and it will you be one of the people watching from the sidelines, or will you be prepared to act? The choice is yours. If this perspective has changed the way you think about investing, make sure to subscribe. Don't forget to check out my free community if you want to scale your own platform in 2026.
Remember, I am not a financial advisor. This video is for educational purposes only. Results depend on your own decisions. Thank you.